Hi everyone. So we are almost at the end of this financial year, and one task that's kind of essential during a time like this is tax harvesting and tax loss harvesting. These are two different things, but pleasantly both help us save taxes on our capital gains. If these terms are a bit new for you, then I'm sure you'll find this video very helpful. It's super timely as well. The 31st of March is just around the corner. By the way, this is episode number 27, and I hope you like it. Right, so one of the questions that naturally comes up is what exactly is the difference between tax harvesting and tax loss harvesting? Let me start with tax loss harvesting, which I would say is a defensive strategy wherein you sell investments that are currently at a loss to reduce your tax liability. For example, if you've made a short term capital gain of, say, 3 lakh rupees on a stock or a mutual fund, and you're sitting on a 1 lakh loss in another, then you can simply sell the loss making instrument to offset the gains. So in this case, 3 lakhs is the realized gain. 1 lakh is unrealized, that is, you haven't yet sold this. And now, if you sell it at a loss, then 3 lakhs minus 1 lakh reduces your capital gains to just 2 lakhs. And this is the amount on which tax needs to be paid. Assuming all of this is short-term capital gain, that is, you've been holding onto these investments for less than 12 months, what would have been 20% of 3 lakhs, that is 60,000 rupees, would now be calculated on 2 lakhs, so 40,000 rupees, saving you a neat 20,000 in taxes. Of course, if you still believe the loss-making instrument is actually a good one, then you can wait for a day or two and invest in it once again. This way, you don't lose out on the potential opportunity and you still end up paying a lot lower in taxes. Sayana, if you are wondering how is this possible, then thankfully our current income tax rules here in India do allow losses to be set off against gains. It's not very straightforward though. For instance, while short-term capital gains can be set off against both short-term and long-term gains, losses of a long-term nature can only be offset against long-term gains. Then there are also sub-rules on how long the unutilized losses can be carried forward, etc., which I can tell you is 8 years. But it's still a good practice to work with a tax advisor on this, especially if you can save 50, 60, 70,000 rupees in taxes. Definitely not an area that you should be doing conjuicy on. That said, let's quickly look at the other one, tax harvesting, which I think is a more proactive and strategic approach to tax saving. This is where one deliberately books profits, even if the mutual fund scheme or the stock is doing well. And you do this to take advantage of tax exemptions and to reset your cost base. For example, let's say you have unrealized gains of 1.25 lakhs on your equity mutual fund. Now you have a choice. You can either do nothing with it, or you can do some tax harvesting and sell all of it, thereby ensuring you pay zero tax on your capital gain. The zero tax scenario is thanks to an exemption offered under income tax rules that say, in the case of equity shares and equity mutual funds, long-term gains of up to 1.25 lakhs are exempt from taxes. Of course, you'll have to book the profit. That is, you'll have to sell those investments for it to become a capital gain. But just like how we discussed it in the case of tax loss harvesting, here too, if you find the stock or the schemes promising, feel free to invest this entire amount the very next day. That is all 8 lakhs of it. So if one looks at it strategically, you've done two smart things here. One, you've taken advantage of the 1.25 lakh LTCG exemption limit and potentially saved a little over 15,000 rupees in taxes. That is 12.5% multiplied by 1.25 lakhs. I think it comes to 15,625 rupees. Secondly, and this part is very important, by increasing your purchase price, that is 6.75 lakhs originally, to a new cost base of 8 lakh rupees, it means any future gains will be calculated from this higher cost base, which in turn reduces your future tax liability. So thanks to tax harvesting, your tax in this financial year is lower, zero in our example. Your future capital gain tax is also lower thanks to a higher cost base. And because you have bought back into those investments, your compounding machine is still very much alive. I'll cover some related stuff in a bit, but I hope this part is super clear. As in, tax loss harvesting is what you do when you want to minimize the impact of poorly performing investments, which is why, in the current context, the last 1.5 years, it's very important. And on the other hand, tax harvesting helps maximize the efficiency of your profitable instruments. So, tax loss harvesting is for your weaker investments. Tax harvesting is for the profitable ones. And either way, it helps you save a bunch of money in taxes. A bunch of money bol to diya. So let's see how to actually do this, the actual execution of all this theory. And thankfully, I have the PowerUp Money app on my phone, which does almost all of the heavy lifting. So I can see here on the PowerUp homepage, it says tax summary. My tax liability for this financial year so far is 1,36,155. And it also says I can save 28,663 in taxes. Oh, I'm so sorry. I'll show this in just a minute. But please note that this tax summary facility is only for elite members. It's not very difficult. Just download the PowerUp Money app, sign on to it, subscribe to Elite, and you'll get access to a host of features such as power ranks, rebalancing, rank trends, and much more. A 1 year subscription to Elite is just 999 rupees plus GST, which frankly is an amazing deal, especially if it can help me save thousands of rupees in taxes. So this entire working has been done by PowerUp Money. Please note this is purely from a mutual fund perspective. And for this financial year, the net realized gains for me is 10.5 lakhs. And the total tax liability as of now for this financial year comes to 1.36 lakhs as per PowerUp Money. Let's go on to some specifics. So we can tap on this thing called view withdrawals, because capital gains can only happen when you redeem either your funds or you sell some of your stocks. So let's view the withdrawals. This is again specific to mutual funds, and see this. Out of the 10.5 lakhs, which was the total realized gains, there is a splitting here between LTCG and STCG. LTCG is the bulk of it, more than 9 lakhs, while the remaining is STCG. You can also look at specific details of this. So for instance, I'm going to tap on LTCG, and yeah, see this 20,000, 50,000. All this is uh, those STPs which are running at the moment, wherein I have invested money in debt funds, arbitrage funds, equity savings funds, conservative hybrid, etc. So it's that money which gets transferred into a pure equity fund on a monthly basis. So I think I have about 2.5, 3 lakh rupees that goes from those safer instruments into the more adventurous instruments. So that's what this is. Uh, I think STCG should also be similar. So see again, this is 50,000, 50,000, 50,000. हाँ देखो वही हो रहा है, right? So that's again these transfers which are happening from the safer assets into riskier assets. LTCL, the long-term capital losses should not be much. Yeah, it's just two of them. So there is this transfer which I had done to quant transfer from quant value fund. I must have just redeemed it. And there was a very small experiment I was running for a friend on the ICICI Prudential Nifty 200 Momentum 30 funds, barely 5,000 bucks. Even STCL shouldn't be much. Yeah, it's just 6 transactions, right? Again, the same STP kind of stuff. Okay, that said, let's focus on the main part, which is STCG. I'm going to tap on this down button, down arrow. Yeah, see, now this gives me the platform has given me a summary of how this LTCG has come about. So there is again a bifurcation here. There is equity LTCG and non-equity LTCG. And this part is interesting. So notice this, the non-equity LTCL, the long-term capital loss, has actually been applied to offset against the non-equity LTCG first. Now, the reason why the system has done this is because the non-equity LTCG generally has a higher tax rate as compared to the equity LTCG. So, if you think logically, it's a sequencing of the various instruments which is happening on the basis of the tax rate. So that's what the system is doing here. So what it's trying to do is it's trying to offset the loss against those instruments first where the taxation is the highest, which is the non-equity LTCG, the debt funds specifically. So that's what it's doing here, which is very clever of the system. And that's what gives me this equity LTCG of 5.79 lakhs and a non-equity LTCG of 3.44. Let's go back a menu. Yeah, this as well. And let's focus on, okay, actually, let's look at the tax liability now. This is the one that says 99,000, just to see how this has been calculated. So I'm tapping on that down button here, down arrow. Yeah, and there we go. See, so far what had happened is this entire thing of LTCG, LTCL, STCG, STCL, it's basically what the system was doing is it was trying to do the tax loss harvesting part. Now it's coming to the tax harvesting bit, wherein from the net equity LTCG of 5.79 lakhs, it first uses up the exemption of 1.25 lakhs. I think the only reason why it has this slash thing here is to basically say that 1.25 is the exemption that's allowed, and you've kind of consumed that entire 1.25. I don't see any other reason. So net of that comes to 4.54 lakhs, and a tax of 12.5% on it is 56,000. The same applies for the non-equity LTCG as well, 3.37 lakhs, apply 12.5 on it, and it's 42. The total comes to 99. One observation here, please notice that the PowerUp system has created this kind of a simplified framework in the sense that it is taking the tax rules which are the present tax rules. So it's not accounting for any kind of outliers or edge cases like any kind of grandfathering which has happened or any merger of the schemes has happened, segregated, which used to happen with debt funds some 5 odd years back. So that segregation thing that has not been taken into account. So, it won't be 100% accurate. There's no reason why it should be 100% accurate. Platforms cannot take care of every edge case. I've worked with ET Money. I know how many edge cases we had to kind of keep aside because it's next to impossible to factor in everything. But this does give you a fairly good idea of what can be your tax liability. That's number one. And secondly, how can you actually optimize your taxes better, which is what we'll now look at. So let's go back and let's focus on this orange box that's there. I think this is the hero of the show. So save 37,526 in taxes. Let's see how it's possible to do this. Okay. Yeah, so the tax saving plan is you can save 37,526 in taxes by booking a loss of 3 lakh rupees from any of these funds. So what are these funds? Okay, there are three of them. There's Motilal Oswal Nifty Microcap 250. Not been going through a good time. There is another one by Mirai Asset, which is the Momentum. The Momentum Fund. This is the small cap 250 Momentum Quality 100 ETF FOF. I know which one this is. And then there is the Motilal Oswal Mid Cap Fund. I had started quite recently on it, so it's gone down massively. Um, I'm just kind of pausing because this doesn't seem to add up to 3 lakhs of losses actually, or 37,000. So see, if you look at the narration here, in Motilal Oswal microcap, it says save 6,900 in taxes by booking 55,000. Okay. Next one is 4,500 in taxes, 36,000 of losses, and 1,400 in 11,000. So this is around 1 lakh of losses, but it says 3 lakh of losses here, which gives me the impression, and I have like a 90% confidence of why this is happening, is because, when I look at my own cams consolidated this thing, there's always that segregated portfolio thing that comes in, which is a massive irritation for every time I look at it. Okay, I mean, for so many years, for some reason, that segregation stuff comes in, and for these systems, as far as these are concerned, it's all garbage in, garbage out, right? So whatever the cams or kfintech or whoever is the data provider, so they send across, the system has to process with what is there. So I think that's what is creating the small dissonance, but I'm going to ignore that overall summation part. I'm going to go one by one. So from the looks of it, it's about 6,900 in taxes, plus 4,500 plus 1,500. So this gives me around 13,000 rupees of taxes that can be saved by PowerUp money using this particular strategy. So if you see microcap 250, let's go inside this and see how that can be done. I think that will be a good exercise. Okay, so 6,933 in taxes can be saved by booking a loss of 55,460. Okay, the fund is anyway off track. There are all kinds of regulatory challenges which have come with this particular fund, because SEBI has said that microcap करके कोई category नहीं है. So, I mean, I should just book a loss. That's what I should do. Anyway, I think I've invested some. कितना है? Oh, okay, this is interesting. Um, so see, what's happened here is that I had invested 7 lakh rupees in this fund. I must have done some STPs and all that stuff. And the current value is 6 lakh rupees. Okay. So if you see right at the top, it's showing that. But if you look at the plan now this is very clever. So I think the system has done a very good job here. So see, the plan here is not to redeem the entire 6 lakhs. The plan here is to withdraw 3 lakh 4,522 rupees from whatever this folio is. And it also says withdraw before 27th of March to avail the benefits. And it's actually taken 3 lakhs odd in terms of value, because I think the system has calculated that it's only these set of units which are currently at a loss. So क्या होता है, because I have bought on an STP basis, I would have bought at this NAV, then at this NAV, this NAV, then ऊपर फिर नीचे ऊपर नीचे सब करा होगा मैंने. So it has not taken in those units which are still at a profit. It has taken only the loss units. So that's why instead of 6 lakh 5,000 rupees, it's saying ये 3 लाख 4,000 रुपए वाला ये जो units है इसको पकड़ो, and you can book the losses on this thing. So that's something this guy has given. There must be a way of doing this. Okay, so I'll also try and figure out from PowerUp on what's the logic they've used. But there is definitely, that's the one thing I can think of. And then if you want, you can actually go in for step 2, wherein you can reinvest this 3 lakh 4,000 immediately in the same fund. I would not advise that. PowerUp Money will also not advise that. And I think that's where this thing of off track comes in. So again, because I'm a elite consumer, I think I get this off track and specifics inside this thing. So if I want to tap on this, I can see it even says here, this fund is off track. Consider switching to a top ranked fund in this category. So, let's do this exercise also. So if I click on Motilal Oswal Nifty Microcap 250, that box which is there. So see I'm right now at 16% loss XIRR, and it's off track. It's been off track for quite a while. And so you can kind of study all these things, right? It was on track, but last 1 year it's been off track, and yeah, it's kind of giving all kinds of details which is there. and you can go in, you can figure out more things. So if I go in for a a leaderboard kind of a thing, it tells me what's available. So there's nothing available here. So better to kind of move away from it. That's there. Anyway, I think this was great for us to kind of do detailing. So just to kind of recap what we have seen, so there have been multiple layers of detailing which have happened, right? So firstly, we started with the overall summary which was there. Within that, we noticed there is LTCG and STCG. We went inside LTCG even further. There was bifurcation between equity and non-equity. Against that, the tax loss harvesting part was put in and the tax harvesting part was put in. Now, this is another layering which says that what exactly you need to do now specifically so that you can book the losses in the right funds and you can get the maximum advantage of your tax optimization exercise. I mean, honestly, I'm like super impressed with what these guys have created. It'll not be completely right. These are estimations. It's still kind of a work in progress. They've just released it. So please do your own kind of verification on top of it. But I think if you want to get a kind of an idea of where you currently stand, where you need to be, what are those schemes you need to move out of, which ones you need to enter, how you can save taxes, how much you can save taxes. I think this does a pretty decent job. I don't know if I said it earlier, but this is a part of Elite within PowerUp Money. It's a subscription feature. It's not expensive, just 999 plus GST. This is for the entire year. And it's not just the tax summary. There is a lot more stuff such as power trends, rankings. There is allocation, which is going to come up. Rebalancing is already there. A bunch of more stuff. So I think if you're someone who is purely into mutual funds, or if the bulk of your portfolio, like mine, is into mutual funds, then I'm sure you'll find it very useful. That said, do remember what we have done here is purely for mutual funds. This does not include stocks, ETFs, real estate, or other sources of capital gains. Secondly, as I explained earlier, these are estimations based on the current tax rules. So this won't have edge cases or some outliers of the past. Then while redeeming certain funds, exit load might be applicable. So please be watchful for that. And finally, other situations like losses being carried forward from last year, etc., are not included. The platform has no way of knowing that. All right, I hope you found this demo useful. That said, let's now go through some of the commonly asked questions. First up, on which asset classes is all this applicable? Okay, very simply, tax harvesting, which is the 1.25 lakh LTCG wala stuff that works on equity instruments only, like stocks plus equity mutual funds and ETFs. On the other hand, tax loss harvesting applies to most asset classes, including equity, real estate, gold, debt, even unlisted assets, but not virtual digital assets like crypto. Next question, is harvesting applied on individual stocks or at a portfolio level? Right. So taxation always works on an aggregate level and not on a per stock basis. Specifically, what people want to know is that if they have a 1.25 lakh profit on five of their stocks, can they claim the exemption individually on each of the five stocks? Well, the answer to that is no. It's 1.25 lakhs in total and not per stock. Another commonly asked question is this one: can I set off losses across different asset classes? The simple answer to this is yes, cross asset sell off is allowed, but within certain rules. For example, any losses in equities can be offset against gains in mutual funds, gold, property, etc. But then one of the restrictions is on the type of gain, as in STCL, short term capital losses, can be offset against both STCG and LTCG. However, losses of a long term nature can be set off only against long term capital gain. Or at least that's what I thought until I came across this article that says the new income tax bill of 2025 has introduced a one time relief allowing any brought forward long term loss incurred up to the 31st of March 2026 to be set off against any short-term capital gains. Okay, next one. Can I carry forward unused losses? हाँ जी बिल्कुल any unadjusted loss can be carried forward for up to 8 assessment years provided you file your ITR by the original due date. And here's the final question. Can I buy back the same stock or mutual fund after selling it for tax harvesting or tax loss harvesting purposes? And the answer to this is yes. Technically, this is what we call as a wash sale, a WASH, this act of selling a security at a loss and then quickly repurchasing it. It is perfectly legal in India. And that's what makes it very handy in these tax optimization scenarios. All right, so that's what I have for today. This is, as you would have guessed, it's very important stuff, and you have about a week to set it right. The fact that the markets are down gives us an added incentive. Some of your stocks and mutual funds would be at a loss, and by selling it, you can be saving on some taxes, and not just taxes. You'll also Okay, so here are the benefits. Firstly, you can manage your taxes better, which means saving some money, which also means better post-tax returns. Secondly, tax loss harvesting helps you clean up your portfolio, that is, selling your losers and reallocating your money. You also get to carry forward losses for a number of years, which can be offset against future capital gains. Then because of the cost reset, remember we discussed it with an example wo 8 lakh 6.75 lakh wala. Well, that reduces your capital gains tax liability on future sales, which is a great benefit to have. And finally, since you can reinvest what you sell almost immediately, this activity does not hurt long-term compounding in any manner. I've been harvesting my taxes for many years. And believe me, once you get the hang of it, you start wondering, why didn't you do that earlier? Anyways, Der Aaye Durust Aaye. If you need any help with this, then download the PowerUp Money app and subscribe to Elite. Lastly, please don't forget, I'm not a tax advisor. I'm a research analyst. So stock research में कोई भी fault हो तो 10 गाली दे देना, but tax related content में I'm not taking any liability on me. So that's it for today. You have a week to harvest as much as you can. I do hope you like this presentation. As always, thank you for your time, and I'll see you very soon.